Everyone, welcome to Media channel. My name is Umar Tariq. So we're going to talk about passive investing versus active stock picking. So passive investing is typically index funds that are a combination of different companies. So like I talked in my previous video, it can be, for example, there could be an index fund of S&P 500, which are the top 500 companies, or it could be an index fund of Nasdaq, which is top 100 software companies, something like that. So if you invest on these companies, that's called an index fund investing because this fund is overly diversified, right? So whatever you bought the share for, let's say you bought it for $100, those $100 are going to get divided into small portions, and a little bit of each is going to go to every single company. Now, let's say if you were doing active stock picking, you're buying individual companies. What does that mean? That means that you're buying, let's say, one company, then you're only buying that company. Let's say you buy Tesla, you buy Apple, you buy Microsoft. Now you only have three companies. What I personally recommend everyone to do is like, don't put more than 5 to 10% of your portfolio in one company if that's what you're doing, the active stock picking. So now let's decide which one is better. Well, let me share something with you guys. Warren Buffett placed this bet, I think 10, 20 years, 10, 15 years ago that, all the hedge fund investors, they come and compare their performance with index funds for next decade. And if they beat the stock market, the index funds of S&P 500, then, he will lose the bet. And it was $1 million bet. He ended up winning the bet, and because none of the people were able to beat the market consistently over a span of 10 years. They were able to beat it, let's say, for 3 or 5 years, but over a span of 10 years, nobody was able to do that. So it's very challenging. Yes, there are people out there who have managed to do it, but the problem is it's like finding a needle in a haystack, right? If there are 500 financial advisors, how on earth would you know which 5 or 10 out of those 500 is that person who's going to beat the market in next 10, 20, 30 years? So in the long run, I feel that index fund investing using dollar cost averaging in a passive fashion is a much better strategy than active stock picking. Also, active stock picking is like, why on earth you would buy a stock, right? How do you know what to buy? So that needs a lot of time, a lot of research. You need to do your research, look at the balance sheets, listen to all the meetings, quarterly report, look at the quarterly reports and annual reports, and come up with your own investment strategy. That for a lot of people alone is a lot of work that they don't want to put in. People have their own, family life, and they have their hobbies and other stuff, so they don't want to put in all this time. So for those people, I would recommend that just do passive investing using index funds, and the reason is that it's better in the long run. Now the question arises: if somebody really wants to do active stock picking, when is a good time to do that? The good and bad time to do active stock picking is when the market is volatile. If the market is less volatile, index funds are so much better. If there's a lot of volatility in the market, like the year 2020, so what that means, the market is fluctuating up and down, and which I foresee that might be happening in 2021 as well, that there will be lots of fluctuations in the market. So what that means, you don't make money when you sell a stock. You make money when you buy a stock at super cheap price. So the problem is, let's say if you buy a stock and it's fluctuating, its price is fluctuating between 400 to 500. Let's say you buy it for 500 and then you sell it 2 years later for $600. You only made $100, right? But if you sell it for 600, but you bought it for 400, then you make $200. So the point I'm trying to make here is, when the market is volatile and when the market is super bearish, everybody is like panic selling their stuff. That is the time when you come in and buy the companies you like. So in active stock picking, there should be some companies based on your research that you really like, awesome companies that you have complete faith in that they're gonna outgrow the market. And once you pick those companies, you buy in batches. You buy a little bit of them when the market, like a regular market, even if the market is high, you just buy them in a very small amount. Then you patiently wait for the market to crash, the stock to come down. That might not never happen. That might never happen, but it happens for almost most of the stocks. 80 to 90% of them will come back, and when they do come back, they fall down 5%, 10%. That's like a 5-10% sale. You just buy in batches. Let's say let's say if there's Apple, right? Apple, let's say, is trading at $100. You buy 2 shares of $100. Then you're like, okay, when it falls to $97 or $96, I'm gonna buy 10 of them. Then when it falls to $92 or $91, then I'm gonna buy 50 shares. Or when it comes to 85 or 88, then I'm gonna buy 100. You get the point, right? The more it falls, the more you buy. So, but at the same time, the problem with this strategy is FOMO, fear of missing out. That you bought, let's say, only 2 shares of Apple at 100, and now Apple is at 130. So what did you do in that case, right? You just lost all that. That is the game here, right? You can't foresee what's going to happen. But what does happen is most of the stocks, they jump up and down, and that is why I'm talking about volatility. That whatever is going up is going to come down at some point of time. So just be patient. It might take 3 months, it might take 6 months, it might take 4 years, or it might not never happen. That's always a chance. So that is why index funds investing is better, in that sense that it's much less draining emotionally and mentally. You don't have to time the market. You don't have to follow your active stock picks. You're just solely relying on stock market to go up and down. And irrespective of if the market is up or down, you use dollar cost averaging, put in a specific dollar amount of money in the stock market. And if the market is down, you buy more shares. Let's say you're putting $1,000 every week, every month, right? So if the market is down, you end up buying 20 shares for $1,000 of your favorite index funds. And if the market is up, you buy only 15. But in the long run, it averages out, and I don't personally feel that there's any better strategy other than dollar cost averaging and index fund investing for the long run. I hope this video helped you, clarified some things. Also, I think about the risks that index funds have way lower risks when you do active stock picking. You not only assume the systemic risks of the market, but you also assume the firm specific risks. Volatility. Index funds overall have way less volatility as compared to active stock picking. The risk of total loss is almost complete to zero, virtually zero for index funds investing, and for individual companies, it's not zero. There's always a chance, right? Even if it is 0.1%, it's always a chance. Management fee is something you need to look at. Don't ever get into an index funds that's like has an expense ratio of 1% or something like that. You should always look for the minimum expense ratio, like a 0.1% or 0.09% or 0.2%, something like that. That's more reasonable. Individual companies, you don't pay anything in the management fee. And return potential, like I said before, if index funds, it won't 5x your money in a span of 2 years or anything like that. Active stock picking individual companies might do that, but at the same time, it can also completely go to zero. So there is more risk, right? Active stock picking index funds investing traditionally has gone anywhere between 8 to 10% for this past in the past century. Active stock picking depends on what stocks you buy. It can 10x or it can go down to complete zero. So just be very careful. I personally lean more towards index fund investing because a lot of people just simply don't have the time and effort to put in the research that's needed for active stock picking. And I think it's better just to do what works in the long term. If, let's say, you're in a super volatile market like we were in 2020, you can buy some good companies for super cheap prices and hold them for the long term. That's not a bad strategy either. So you decide whatever works better for you. I hope this video helped you. If it did, please like it, subscribe to the channel, share it with others. Like I always say, never give up, never lose hope. Bye.